Did you know that a simple mistake in your 401k management could be costing Americans a staggering $172 billion every single year? That's right. Fees and penalties for your 401k can often be avoided if you understand how your plan works. In this video, we're going to dive deep into the most common 401k mistakes that could be draining your hard-earned retirement savings. And more importantly, we'll explore how to avoid these costly errors. One of the most common pitfalls is accepting a low default savings rate. Many employees are automatically enrolled in a 401k plan with a default savings rate of just 3%. However, experts like Shannon Nutter, Wierzbicki from Vanguard emphasize that this rate is far from sufficient. Imagine starting a 12% savings rate instead. The benefits of compounding over time would be enormous. If you can start with such a high rate, don't worry, you can gradually increase your contributions each year, especially when you get a raise. For example, setting your 401k to automatically increase when you receive a raise ensures that you are consistently building towards a more secure retirement. Another major mistake is missing out on your employer's 401k match. A typical match might be 50 cents for every dollar you contribute up to 6% of your salary. That means to maximize this free money, you need to contribute at least 6% of your salary. Many people leave money on the table by not contributing enough to get the full match. It's essential to know your company's match formula and make sure you're contributing enough to take full advantage. Failing to maximize tax breaks is another costly error. In 2020, for example, workers could defer paying income tax on up to $19,500 in their 401k contributions. Those aged 50 and older could contribute an additional $6,500 as a catch-up. This means that a 55-year-old in a 24% tax bracket could potentially reduce their income tax bill by $6,240 if they max out their 401k. Lavina Nagar, a certified financial planner, stresses the importance of stretching your contributions to the maximum limit allowed to reap significant tax benefits. Automatically accepting the default investment in your 401k is another area where people often go wrong. Most default options like target date funds may not align with your specific retirement goals or risk tolerance. While these funds are convenient, they might not offer the best performance or lowest fees. It's crucial to review your options and select the investments that best meet your needs. Speaking of fees, paying excessive 401k fees is another common mistake that can quietly erode your retirement savings. Not all 401k plans are created equal. Some have lower cost options, while others are burdened with high fees. Your plan is required to provide an annual fee disclosure statement, which can help you identify and switch to lower cost funds within your plan. John Scott from the Pew Charitable Trust recommends checking these documents regularly to ensure your 401k fees are as low as possible. Leaving a company before you are fully vested in your 401k is another costly error. Vesting schedules vary, with some companies requiring you to stay for several years before you can keep the employer's contributions. This is why it's important to understand your plan's vesting rules and consider them if you are thinking about changing jobs. Leaving too soon might mean walking away from a significant amount of money. One of the most financially painful mistakes you can make is triggering the 401k early withdrawal penalty. Withdrawing funds before the age of 59 and a half typically incurs a 10% penalty on top of regular income taxes. For example, a $5,000 early withdrawal by someone in the 24% tax bracket would result in a $500 penalty and $1,200 in income taxes. However, special circumstances like the coronavirus pandemic allowed for penalty-free emergency withdrawals in 2020. But it's always best to avoid tapping into your 401k early unless absolutely necessary. Similarly, initiating a 401k loan is another move that should be approached with caution. While you can borrow up to 50% of your vested account balance, loans come with fees and the interest you pay is not tax deductible. Moreover, if you leave your job, the loan must be repaid by the due date of your next tax return. If not, the loan will be treated as a distribution, triggering taxes and possibly penalties. As you approach retirement, don't forget to take your required minimum distributions from your 401k. The IRS mandates withdrawals starting age 72, and the penalty for missing an RMD is a hefty 50% of the amount that should have been withdrawn. Some retirees choose to start withdrawals in their 60s to spread out the tax burden and potentially pay a lower tax rate. The CARES Act allowed retirees to skip their 2020 RMDs, but normally failing to take your distributions on time can be a costly mistake. Finally, it's important to address any mistakes that have already occurred in 401k plan. The IRS offers several corrections programs to help you fix issues like missed deferrals, improper distributions, and plan loan errors. Whether you need to self-correct a minor error or seek assistance through the voluntary correction program, taking action now can help you avoid bigger problems down the line. Remember, it's never too late to make adjustments and get your 401k on the right track. If you found this video helpful, be sure to like, subscribe, and share it with others who might benefit from this information. Thanks for watching, and we'll see you in the next video.